So the focus of this chapter is on company valuation. And there are some unique characteristics about valuing a privately held company. We're going to go over two examples. The first example is an existing company that has been around for a long time and is up for sale. And we want to look at how do we assign a value to that. So first of all, we're going to take a look at the company's historic income statement. So here are the company statement for the past 4 years, and then this is the projected current year. Um, so what are some of the things that we want to look out for when we look at income statement? So we focus on things that will change if ownership changes hand. So some of the things that oftentimes stand out are wages. So when I look at, who is getting paid and is that a fair market value that they're being paid at? Something a little bit interesting is going on. You notice that the wages for officers started 4 years ago, 5 years ago at $113,000, and then is increasing at a really rapid rate. And this year is projected to be $259,000. So there's something definitely going on there. Other things do increase, but they are more in line. So for example, repairs and maintenance that tend to fluctuate a little bit, and that's not surprising. Um, Other areas, again, that seems to increase, but at a steady rate, so that also may make sense. The other thing that you notice is retirement contribution, again, that more than double over the 5-year period. So again, those are things that we want to take into account. The other things that we also want to take a look at is recurring expenses or expenses that we think will not recur. So both. So most of the sales, cost of goods sold, and operating expenses are recurring. Other expenses are typically non-recurring. So in here, instead of marking an interest expense, they use negative interest income, so to mark as an expense. So this is one of those accounting quirks. Gain on sale of assets. So again, you don't expect that to happen all the time. So we can expect that to be non-recurring. So these are things that we don't think will continue to happen if we purchase the firm. So those are the things that we want to pick up when we are evaluating the financials for a company from the point of view of acquiring it. So because most of these are non-recurring, our focus is going to be income from operations. So we want to look at the current income from operation, which are the recurring income and expenses, and then we're going to make adjustments. So we're going to talk to the owner, find out and ask a lot of questions to find out what we expect to change and what we expect to remain the same. So let's go to table 2. Table 2 includes information that are estimated by the buyer. Notice that the first 3 adjustment items are to the wages, retirement contribution, and health insurance premiums. And the reason for that is because they look at the existing contract, and what is happening is that the existing owners was paying himself a lot higher wages because the company has been profitable and he's been putting away money into retirement contribution and getting a high health insurance policy for himself and his family. The new owner knows how much he wants to pay himself. So, and hence you notice there's no variation between the low, high, and average estimate. So the new owner says that they're going to cut wages by $100,000. They have absolute control over that because he is the new owner now and he can decide how much to pay himself and how much to put in retirement contribution, also what kind of insurance policy he wants to buy for himself. So there's no uncertainty when it comes to this kind of savings because that's what the new buyer intended to do. There's some uncertainty when it comes to savings from cost of goods sold. Remember that they believe there is synergy by buying in larger quantity. They think they can get a better price. So here are their estimate in terms of savings through cost of goods sold. So the total adjustment to income from operations. So in here, we just simply add up all the adjustments. So savings and wages, retirement, health insurance, and cost of goods sold. So the projection for this year, so first we take income from operation. We take that from the historic data. So we use the equal sign. So again, notice that we start with equal and we go back to table 1. Here is our income from operation for the current projected years. And our adjustment to the income from operation, we computed that here. So our adjusted income will be the sum of these two. So remember that this is savings. So these are positive contributions. So right now our income is $132,000. We believe that with the adjustments, by saving in terms of wages, retirement, health insurance, and cost of goods sold, we can get an additional $152,500. So our total adjusted income will be $284,500. Next, we're going to take a look at valuation. Um, Now, this company, the valuation that we're going to use for Dimmons Fuel is going to be the stable growth discounted cash flow method. So we're going to walk through this step by step, and all of these formulas are included in your textbook. I've reproduced here in the spreadsheet, so it's easier for you to use them. So first, we start with adjusting income from operations. So we already did that. So let's bring that over from table 2. And then our after-tax cash flow is just income from operation times 1 minus the tax rate. And the owners already estimated what the return on asset is. And they also have a target long-term growth rate. So these are estimations that they have already done. Once they purchase the company, in order to sustain this long-term growth rate, meaning in order to sustain growing 4% per year, approximately 4% per year, they'll have to keep reinvesting in the company. So the reinvestment rate is defined as the long-term growth rate divided by the return on asset. So in order to achieve a growth rate of 4.8%, let's change the decimal place on that. We will need to reinvest 20.86, so approximately 21% of our earnings back into the company. So next we go into the reinvestments. So reinvestment is the after-tax cash flow times the reinvestment rate. So we have $184,925 in after-tax cash flow, but we have to invest about 20.86% of that each year. So we have to reinvest $38,573. At this point, they do not envision using any debt financing in this purchase, so the debt ratio is 0. If the debt ratio is 0, then what that means is the next thing we want to compute is the free cash flow to equity. So the company generates $184,925, but we have to reinvest $38,573. Now, if we were borrowing part of that reinvestment, then the cash flow to equity will be smaller. So the free cash flow to equity is defined as the after-tax cash flow minus the reinvestment amount times 1 minus the debt ratio. So this is 1 minus the debt ratio is the portion of the reinvestment that will be financed by equity. Since debt ratio is 0 in this case, the owner is financing 100% of the reinvestment. So this is equal to after-tax cash flow. So that's the $184,925 minus reinvestment of $38,574 times 1 minus the debt ratio. In this case is 0%. So in other words, the company generated $284,500 and we paid 35% in tax. We have to also, and that takes us down to $184,925. we have to reinvest $38,573 on average per year in order to sustain a growth rate of 4%. Next, we're going to compute the cost of equity, and this one is slightly different than what we saw last time. The main difference here is the illiquidity discount. There are two ways we can handle illiquidity. Illiquidity means it's difficult to buy and sell a business. We can include that in the cost of equity, or we can subtract it from the value of the firm. In this particular example, we're going to subtract the illiquidity discount directly from the final value of the firm instead of from the cost of equity. And notice that in here, the systematic risk and the unsystematic risk adjustment didn't come into play because both buyers are under diversified. So in here, we simplify the cost of equity. This is simply the risk-free rate plus the beta times the equity premium. So the cost of equity is 15.24%. We are using unlevered beta because the company has a debt ratio of 0. So again, if the debt ratio is not 0, we'll have to go through the beta adjustment to this as well. So the equity value, remember that we are using the constant growth model or stable growth model. So this is the price today is equal to the estimated cash flow next year. So we take the cash flow times 1 plus the growth rate divided by the required return, which in this case is cost of equity minus the growth rate. So this is a constant growth model. So we take free cash flow to equity, which is $146,000, times 1 plus the long-term growth rate, which is approximately 4%, divided by the required return, which is cost of equity. Because we're using free cash flow to equity, the discount rate is cost of equity, minus the growth rate. Again, that's approximately 4%. And that gives us the equity value. Next, we have to multiply that or subtract that out the liquidity discount. So we take the equity value times 1 minus the illiquidity discount. So this gives us the equity value adjusted for liquidity. And you can also take a look at what that would be if you use the low estimate. So if this is $27,000, you can do a scenario analysis and see what the range of the value would be. In this case, the only variable is the cost of goods sold. So the variation, the range of value is not significant. You will find that the range of value is approximately $50,000. Okay, so this concludes the example for Dimmons Fuel, which uses the constant growth model, and we use the free cash flow to equity holders, and also the cost of equity as the discount to estimate the value of the firm.